there are signs of a slowdown hitting some of the world's largest economies. Japan's economy contracted 2.5% in Q3. Today's revision was much worse than the previous reading of just over 1%. France has forecast growth will cut in half. Recent protests are hitting the economy. Questions over Macron's ability to reform France. And Goldman Sachs says the odds of US raising rates now in March are less than 50%. And I haven't even mentioned Brexit. Those are the issues. In all of this, Jared Woodard is Global Investment Strategist at the Bank of America, Merrill Lynch. Good to see you, sir.
Great to see you.
Of all of those factors, which do you think is the most telling and important?
The most important factor right now is that central banks are raising interest rates, they're tightening policy, and they're doing it at a time when it's increasingly clear that we're in a late cycle market environment. That's why our view for 2019 is bearish on stocks, bearish on bonds. We do like commodities. We especially like cash. We think it's a time to be defensive.
Here's the old question you get asked all the time. The rule is always if stocks are doing well, bonds are not, and vice versa. To have a scenario where both are doing badly, what's gaining? What's going up?
This is a really strange time. It's a kind of market that we haven't seen for 20 years. If you look at the returns in October from a portfolio that's 60% long U.S. equities, 40% long U.S. bonds, they both fell. It was the worst month for that kind of vanilla.
Why?
It's happening because you're seeing inflation rise and interest rates rise at a period where the great news is already priced in. And so our contention is that the 30-year bull market in bonds that most investors have enjoyed is really come to an end. So that's why...
Slowing down, taking a rest, or come to an end? Because you're not forecasting, or are you forecasting a bear market?
We're forecasting really terrible returns for the first part of next year. We think that it has to get much worse before it gets better. There's a few things that investors can look for to know when it's a good time to step in. I think number one, most importantly of all, is a big profits outlook reset. Profit expectations are too high for next year. The analyst consensus is looking for 8 to 10% global earnings growth. Our top-down macro model suggests you should look for 0 to 5% earnings growth at best next year, and until profits reset, you can't get back in.
Can I ask you a rude question?
Yeah, sure.
Why should we believe you?
Well, we take the data as we see it. I don't make money from calling yes or no or red or green. I look at...
I guess what I'm saying in a sort of slightly pejorative ways, we have people on this program who say that it's not going to be a great year next year, but they're not as pessimistic as you are.
Right. A lot of folks are looking at data that's out right now, at expectations that reflect the U.S. tax cuts, for example. And there's been a lot of hopes pinned on those tax cuts as prolonging the business cycle and leading to a big boom. But we haven't seen that in the evidence yet. And when we talk to CFOs around the country and ask them their spending plans for the future, they don't tell us that kind of story. They don't say that they're going to make big new investments in factories or equipment. Instead, they say they're really worried about trade. They're really worried about how late it is in the cycle and how interest rates are rising. And so until profits reset, until the policy environment changes, it's not a great time to be in.
So 401ks, you pretty much leave them as they are. Pension plans, large scale, those, leave them as they are because there's not really much you can do.
You can do some things. You can take some of the gains that you've seen in U.S. tech, most of all during this cycle, all the places where Wall Street has done...
But so much of those gains have just been given back.
Absolutely. It's better to sort of take gains where you have them, or even realize some small losses where you have them, and move to cash to look for better opportunities down the road. We think that by May of next year will be a great time to start looking for really committing capital, because at that point, we expect that we hope that you'll see a Fed that's either come around on the tightening cycle. We'll see maybe progress on U.S.-China trade tensions, and possibly a big profits reset and positioning capitulation out of these bullish positions that investors have built up for so long. Until those things happen, it's just not a great time to get in.
The interesting part I find of what you're talking about is not that it's not a great time to get in, but that it's a good time to get out. Because the many people will also be saying, you'll hear people saying on this program, well, if you haven't sold yet, it's not worth doing it now because you're already showing, the market's down. You may as well ride this thing out.
Look,
you don't subscribe to that?
I don't subscribe to that view. If you just look at market history, there's a lot of places where, look, the S&P 500 just dipped into negative territory year to date. we've seen a lot of 10 and 15 and 20% corrections and even bear markets that began exactly this way. For investors that are looking for where to commit capital today, if they've got cash in hand, what should I do with it? This is not the time to buy. And for investors who have realized big gains, incredible gains, in the U.S. tech sector, in developed market equities over the last 10 years, it's worth stopping and thinking, can I tolerate 5, 10 plus downside, especially if, as we think, this is late in the cycle, a moment when the Fed is tightening. There's a lot of historical analogs where you would have done really well to take your gains, to realize those positions, and wait for a better entry point later on.
6 months ago. One would have been wise to have done it 6 months ago.
Some folks on Wall Street, I won't name pat anyone in particular on the back, but some folks have been warning about some of the risks to tech most of all, to the populist threats around the world most of all. And I think those are warnings that are important because when we look at what's happening, you mentioned Macron, you mentioned Brexit, think about the state of U.S. politics. This populist revolt, we think, is real, it's powerful, and it's only just beginning. And until policymakers change those policies so that Main Street catches up to the gains on Wall Street, we think you can expect more of these kinds of revolts.
You can understand it's very difficult for ordinary investors to know what to do in these scenarios when the buy on the dips philosophy has been so prevalent for so long.
Right.
You've got growth of 3 to 4%, which may not be next year, but at least you've got low unemployment, low inflation, moderately rising interest rates. You have a Goldilocks scenario in the United States.
Goldilocks for the moment. For the moment. The question is, if we don't get big capex, if the Fed continues raising rates, and most importantly, if the profit cycle rolls over, which we think is already happening, then it's no longer Goldilocks, it's run for the hills. So in that kind of world, the good news is T-bill yields you 2%. That hasn't happened in 10 years. It's a great time to park that cash.
Good to see you, sir.
Thanks.
Thank you so much. Thank you.